As an alternative policy, he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely, to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4.5% on high-grade taxable bonds, and 3.5% and 4.5% on good tax-free bonds. The dividend return on leading common stocks, with the DJIA at 892, was only about 3.2%. This fact and others suggested caution. We implied that at normal levels of the market, the investor should be able to obtain an initial dividend return of between 3.5% and 4.5% on his stock purchases, to which should be added a steady increase in underlying value and in the normal market price of a representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 7.5% per year. The half-and-half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5% and even more, against 4.5% in 1964. In the meantime, the dividend return on DJIA-type stocks had a fair advance also during the market decline of 1969-1970. But as we write, with the Dow now at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year bonds during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn that a long-term bond may vary widely in price in response to changes in interest rates. In light of what has since happened, we think that this warning, with attendant examples, was insufficiently stressed. For the fact is that if the investor had a given sum in the DJIA at its closing price of $874 in 1964, he would have had a small profit thereon in late 1971. Even at the lowest level, $631 in 1970, his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always, bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, or other so-called equivalents, and leading DJIA-type stocks. What course should the investor follow under present conditions, if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks, and also on an average annual appreciation of about 4%. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciations on stocks. Consequently, we are forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course, we cannot be certain that bonds will work out better than stocks from today's levels. The listener will immediately think of the inflation factor as a potent reason on the other side. Our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there is always the possibility, though we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable without stepped-up inflation as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds, even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy for defensive investors, namely that at all times they have a significant part of their funds in bond-type holdings, and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We have done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities, which have a separate Dow Jones average to represent them. But the major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately, that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of the defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. We shall repeat here without apology, for the warning cannot be given too often, that the investor cannot hope for better than average results by buying new offerings or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude, let us mention supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds or commingled funds operated by trust companies and banks in many states. Or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. Another concept is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way, he buys more shares when the market is low than when it's high, and he's likely to end up with a satisfactory overall price for all of his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum in inverse relationship to the action of the market. These ideas have merit for the defensive investor.